lawmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Australia's Prime Minister, Anthony Albanese, has set out options for strengthening gun laws following the country's worst ever terrorist attack. 16 people, including one shooter, were killed after a gunman opened fire during a Hanukkah celebration on Sydney's iconic Bondi Beach. Let's bring in Bloomberg's Swati Pandey in Sydney. Swati, bring us up to date with the latest developments and what the Prime Minister is actually proposing to do to strengthen these gun laws.
Good morning to you, Francine. So Prime Minister Anthony Albanese held an emergency meeting with the state and national leaders, and they have agreed to strengthen gun laws in the country. And remember, Australian gun laws are already really strong, and it's really difficult to acquire firearms in this country, but they are going a step ahead. And the cabinet has tasked police ministers and attorney general to explore options, including caps on the number of firearms that people can hold, limits on open-ended licenses as well, because one of the shooters has had licenses for almost a decade. And Albanese pointed out during one of the press conferences earlier in the day that circumstances could change, people could get radicalized over a period of time or have any other issues which could prompt them to become violent. And so there should be a limit on open-ended licenses. And then there are also stricter rules on the types of guns and modifications, as well as a requirement that license holders should be Australian citizens. So these are being considered at the moment, and it looks like it will have the support of all parties necessary to get through as well.
Swati, a bystander is also being hailed a hero after tackling one of the gunmen. What more do we know?
Yes, that is being celebrated across the country, and the gunman is being seen as the bystander has been seen as a hero. He is identified as this 43-year-old man who owns a tobacco shop named Ahmad Al-Ahmad. And it was really heroic. And the Premier of New South Wales State, home of Sydney, he said without this man, there would have been more lives lost. Unfortunately, he took 2 gun wounds as well, and he's in the hospital at the moment. Earlier, Donald Trump, US President, he mentioned this man as well and hailed his heroism. Billionaire Bill Ackman mentioned how there should be rewards given to community heroes like this, and he in fact donated $99,000 to a GoFundMe page for crowdfunding, and the money would go to Ahmad. And last when I checked, that FundMe page had more than $775,000 that was raised. So yes, it is seen as one bright spot in this really dark moment. And it's really unfortunate that something like this has happened at this time of the year when people are thinking about holidaying, spending time with their family. And so it was really courageous that this man came before the police arrived and prevented some of the damage at least.
Swati, thank you. Swati Pandey there. And as Swati was reporting, there were 2 gunmen involved in the attack, a father and a son. Now, in the U.S., police have released a person of interest after a shooting at Brown University in which 2 people were killed and 9 were wounded. All students have been sent home and final exams have been called off. The shooting took place in a classroom in the engineering building at the Providence, Rhode Island campus on Saturday. Now to other matters, and of course we continue looking at the markets, where this week we'll see a flurry of U.S. data, including CPI, non-farm payrolls, and retail sales numbers. Those come along with decisions from the Bank of England, the ECB, and the Bank of Japan. With us now, Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen, and David Power of Bloomberg Economics. It's the last stretch of course, 2025, the only full week, but there's absolutely 100% a lot going on. Thank you both for joining us. Laura, what are you looking out for this week? I mean, we have a number of central banks, but it's also really trying to guess what happens in 2026 with the Fed.
And I think really the central banks will likely take the attention this week. I mean, my focus is on the Bank of Japan in particular. Mm-hmm. We have seen the significant rates repricing across G10. Japan has really been a key kind of driver of that. And even though we're seeing that rate hike already priced in, I think guidance will be crucial. Are they going to assess that they don't no longer need to take that gradual stance? And what does that mean? Is that a quarterly pace of hikes from here? I think that's probably going to draw the most attention relative to the BOE and the ECB. Mm-hmm. And I think the Fed, the data is a bit more of that backwards-looking gauge at this stage.
Yeah, and David, when you look at the Bank of Japan, I mean, there was just a lot there in the last couple of weeks, right? A little bit of anxiousness as there were leaks that then had to be, I guess, confirmed by the Bank of Japan.
Yeah, there's lots been going on, but as we've just heard, they in all likelihood will hike this week, given the strength of inflation there, and also the ease and uncertainty related to trade, the trade stance with the United States at the moment, and they're really kind of bucking the trend globally. There's very few other central banks are hiking right now. Most of them will be easing in 2026, but there's a different story in Japan.
Yeah, I mean, this is a concern, right? That actually it's really difficult going against the grain.
Well, I think the really interesting dynamic we've seen in markets is just the extent we've seen from easing expectations for 2026 now towards tightening expectations. If we look at kind of Australia, Canada, if we look at the ECB, markets are starting to position not just for the end of those easing cycles, but the resumption of those hiking cycles. Now, some of that is warranted based on fundamentals. I would argue Australia certainly, and even the ECB, we've been a bit of an outlier in expecting a rate hike in the latter part of next year. But again, I think there's just so much uncertainty. Some of that is year-end liquidity issues. I think that's going to drive some more volatility.
Okay, more volatility to come. What can we expect from the BOE? I know they hate talking about the terminal rate, David.
Well, what we can expect is a rate cut. That's our call this week, and then we can expect probably one more next year, which would basically bring the terminal rate to 3.5. Which is kind of broadly seen as a neutral rate for the BOE. So we've got a bit more easing there, unlike the ECB, where they're probably close to the end already, or if not at the end, actually. And markets, as we just heard, are toying with the idea of hikes, particularly after some very hawkish words from the executive board member, Isabel Schnabel, last week, which encouraged a lot of dialogue and market pricing in that direction.
Laura, when you look at the Bank of England, I mean, again, it does seem to be, I guess, a more complex situation because some of the domestic pressures, but also there's just a sticky inflation, and the votes are so close that you kind of wonder what 2026 brings.
Yeah, and I mean, our view is that we expect they're going to have to take a more aggressive easing stance, and that's largely predicated on, yes, services inflation still remains sticky, but it is coming down. We're seeing some signs of labor market deterioration. Just looking at that vacancy to unemployment rate is deteriorating. That suggests we're going to see some softness in wages that can spill into services. And I think overall, yes, the budget was kind of this risk-clearing event, but we still have a fiscal drag of about 1.5 percentage points over the next 2 years. So all of that together suggests, we could have about 3 Bank of England rate cuts until the end of the cycle. And we do expect Governor Bailey will be firmly in that rate cutting camp, shifting towards maybe a 5-4 vote this time. So still quite divisive. But I think overall we're leaning towards that. And I think that does open attractive opportunities in gilts as well.
I was going to ask you about gilts. So first of all, you see the terminal rate at 3.25.
Yes.
I mean, we've tried to ask any really Bank of England MPC member where they see it going. Why 3.25, and what does it mean for gilts?
Well, I think, ultimately, at this stage, we have seen gilts caught up in the global rate sell-off. So it's been a very difficult trade to extend duration in the UK. But I think the fundamentals still justify a lower 10-year yield. But we're positioning now more in towards the belly of the curve. I think the risk-reward profile is better in terms of, scope for more easing to be priced in, but as well not getting caught up in some of that global rates repricing, particularly looking at boons and treasuries, which we think will be much more volatile and stickier at higher yield levels next year.
And then the ECB, I mean, Isabel Schnabel kind of, gave Bloomberg an interview saying there's 3 words. And the market is kind of like, no, wait, we don't know when a hike will happen. What do you see it happening, David? Is it kind of steady as she goes until the last quarter of next year for the European Central Bank? We
don't think the ECB will be hiking at all next year. I think they'll remain on hold for the foreseeable future. In fact, we actually see downside risks for more easing next year. That's not our core scenario, but we think that's how the risks are skewed, because the full impact of the rise in U.S. tariffs will only be felt with time in the euro area, and the ECB will probably struggle to meet its inflation target. We'll be getting updated forecasts from the ECB staff economists this week, and we already know from September that those projections showed inflation below the 2% target for the next couple of years, and we'll probably see that again. And the rise in U.S. tariffs, the lower demand for European exports will only make that problem worse. So we're firmly in the camp of no hikes for the ECB in next year, despite Isabel Schnabel's warnings. And by the way, she didn't give a time. She didn't say she looks for it next year.
Or the next move is a hike, which could be long into the future.
Yeah, if you look at what's being priced in the market, there's a little bit, a few basis points priced in for next year, but not even a full 25 basis points. So the market's not really expecting that. What she was referring to in that interview that she gave to Bloomberg and Market Expectations, if you look further out on the curve, there are hikes being priced in kind of over a 2-3 year horizon.
Laura, what does it mean for where you want to be invested in Europe? Bunds, I guess, look less attractive than other European bonds.
I think that we're seeing a structural shift in terms of European assets because of the fiscal stimulus dynamics that is underpinning our constructive view for Europe next year. So we think that German 10-year should be trading above 3%. I mean, we are seeing more of that seasonal factors driving the underperformance this quarter. I mean, 8 out of the past 10 Decembers, we've seen bunds underperform. And then we also have that very strong January technical headwind around supply. So we struggle to see opportunities in extending duration, certainly in German bonds. I think the periphery is much more attractive from a carry perspective. And then looking at European investment grade credit, I think, is really where you're seeing better risk return rather than taking that government debt exposure.
Laura, how much of 2026 will just be focused on AI valuations and whether they're too lofty?
I think it's going to continue to be that key question. Are we seeing the makings of an AI bubble persist? I think at this juncture, we're still leaning into U.S. large cap stocks. The earnings are quite robust. U.S. equity performance is all about U.S. earnings. We look at expectations for earnings about 10 to 12%. That's not necessarily a significantly high bar, I think, to surpass. So still remain constructive. And if we think about the U.S., we're going to have ample fiscal stimulus come through. We're going to have that AI tech investment. AI investment has already added 1/5 to the U.S. economy this year. And then if we think about the resiliency of consumption, we have tax rebates coming through. We have likely tariff clarity that's going to boost real wages. This is really a dynamic next year where I struggle to be kind of bearish on the U.S. equity market, even though there are certainly pockets of risk.
So interesting. Thank you both for joining us. David Powell, Senior Euro Area Economist at Bloomberg Economics, and Laura Cooper, Global Investment Strategist at Nuveen. He's been very generous with her time, actually, so we hope we see even more of you in 2026. Coming up, Ukraine and the U.S. are holding a second day of talks in Berlin on a plan to end the war with Russia. More on that story next with Amundi Investment Institute's Anna Rosenberg. This is Bloomberg. Are holding talks in Berlin on a peace plan to end Russia's invasion. The Ukrainian President Volodymyr Zelenskiy has signaled Kyiv could accept security guarantees from the U.S. and Europe in place of its long-term goal of joining NATO. Well, with us now is Oliver Crook, Bloomberg's chief Europe correspondent. Ollie, so walk us through the latest comments by Zelenskyy that seem like a big deal, which come ahead of more talks today.
That's right. And they come around the talks that happened yesterday in Berlin, which were attended by Jared Kushner, Steve Witkoff, and Volodymyr Zelensky, speaking in Berlin yesterday for 5 hours. We should say that it was a significant and I think meaningful fact that there was a U.S. delegation actually attending those meetings yesterday and today. You'll remember going into the weekend, President Trump suggested that really he would only send a U.S. delegation if he thought that any forward progress could be made concretely. Those talks yesterday lasted about 5 hours, and the U.S. said that they were very pleased with it. They said that a lot of progress had been made. The comments that we're focusing on today are the ones of Volodymyr Zelensky, suggesting that basically they could very openly basically withdraw their ambition in some way, scale it back, of joining NATO, which of course for the Ukrainian perspective is seen as one of the only ways to secure no further invasion or future invasion by the Russians at Article 5, with an Article 5-like guarantee from the United States and the Europeans. That being said, anything that approaches Article 5 is going to be a problem from the Russian perspective, and we've not yet heard their perspective on some of the latest proposals that we've been hearing from this 20-point plan as it evolves. We should say that now the conversation will evolve today in Berlin, where you have 10 European leaders. You'll have Mark Rutte, the Secretary General of NATO. You'll have Ursula von der Leyen there as well today to have those discussions. But really, Francine, I think the most significant thing out of Europe this week is that EU leaders meeting that begins on Thursday. And I have to say, as of Monday, as of today, looking 3 or 4 days ahead of this meeting, I still find it very difficult to see whether or not the European leaders will move on those Russian assets, which is absolutely key in terms of funding the war in Ukraine for the next couple of years. That is, I think, still an open question, something that Kaja Kallas, the High Representative, going into a meeting today, said it's getting more difficult to see if there is actually consensus there.
Ollie, thanks so much. Oliver Crook there, Bloomberg's chief Europe correspondent now. Let's also bring Anna Rosenberg, head of geopolitics at the Amundi Investment Institute. Anna, thank you for joining us. And of course, Russia is not present at the Berlin talks, and Vladimir Putin seems also to be showing no signs of pulling back from his maximalist demands in Ukraine, including on territory. So what are the chances of these negotiations actually, leading to something meaningful?
So I think what we're seeing right now is Europe trying to reinsert themselves into this equation more strongly, to the degree that they are trying to put the European position, the Ukrainian position on paper much more strongly than what we saw in the original plan. That's what we're seeing. The other thing that we're seeing is Ukraine being very open to try and achieve a ceasefire, to keep the US happy. So that's what's going on right now. I don't think we're really talking about the end of the war yet. We're seeing a realignment of positions and Ukraine trying not to lose the US. And this is what's going to dominate the week. I think it's early to say that this is going to lead to a breakthrough. The ultimate sticking points are the same. The security guarantees are critical for Ukraine, are a problem for Russia. Russia wants to see the capitulation of Ukraine as a sovereign state. And I think it's quite unlikely that they will agree to anything that prevents that from happening in the future. So,
and do you think that can there be elections in Ukraine? Like proper elections?
There could be elections once they agree on it, but you need preparation time. It's going to take a couple of months. You need security, and that is an opportunity to gain time for Zelensky as well, and to get security guarantees through the back door, and to actually achieve a ceasefire through the back door too. So we have seen Zelensky giving a lot. Giving up on NATO membership, which was never realistic in the first place. Now floating a referendum or elections to try and buy time, really, and to show that to the US, we're serious about this. Stay on our side.
What do you think the US will be happy with at the moment? I mean, this feels like actually placating the US president so that he continues giving his support to Ukraine.
I think the US wants to see territorial concessions. They want to see movement on the Ukrainian side. They want to see that things are progressing into the direction of the ceasefire. The issue is not the US, it's not the Europeans, it's not Ukraine. The issue remains Russia. They are holding the card. So I think what's happening at the moment is that we're seeing unity around a US, Ukrainian, European position emerging. And that in essence brings us closer, because then there is a common ground for talks that the West, if you will, represent. The question is, what does Russia do next? And for Russia, this is going very well, because what Russia wants to see is a divided West. Russia wants to see Ukraine giving up already on its key demands without doing very much, without compromising. So we are likely going to get to a point where Russia says, okay, this is good, but it's not good enough. I need to see more. And then we could see another pivot where the US says, okay, Russia, we've given you what you wanted. You are not doing this. I'm afraid we have to ratchet up sanctions again. So this is still early, and as of now, I think a ceasefire is not the base case.
Despite what happens in Ukraine in the shorter term, how do you think this war will have changed Europe?
Well, it's changed Europe quite a lot. For one, it's become clear that Europe doesn't really have a lot of geopolitical power in this world, because in this kind of multipolar world, what counts is that you have military might, ideally in the form of nuclear weapons, that you have natural resources that someone else depends on, food, energy, rare earths, for example, and that you have a lot of partnerships. So that's something that Europeans have. We have seen Germany, ironically, once again being the country that is creating a massive military muscle. You know, history is ironic sometimes, where the rest of the European countries don't have the finances to spend on defense. This is going to change Europe quite significantly, where Germany is once again becoming a more important player. There's a realization that they need to emancipate themselves from the US military umbrella as well. This is going to take time, but it's likely going to accelerate from here. So Europe has to move from an economic union towards a more geopolitical union. Yeah. I think that despite the divisions, we have seen a lot of coherence, very little divisions actually, in managing Trump. So far, the European nation states have realized that they need each other in this geopolitical divided world.
And is there actually recognition when European leaders listen to the White House say that it's a decaying continent with decaying leaders, that they need to step up?
I think there is a recognition. It's not news, right? We have seen the Draghi report, etc., about the challenges that Europe faces. The problem is that leaders are facing a lot of political constraints, and they're not moving fast enough, and they're not being bold enough and creative enough. And oftentimes you see that the political debate is dominated by very local issues, and that there is not a lot of honesty with the public, and that is overall holding the continent back in being bolder and more innovative. They get that. But as usual with the European Union, it takes time to get there. And the political constraint is an issue. Yeah.
Do you worry about these political constraints into 2026?
Yes, I worry about it. I think that there's a lot to worry about, but overall we shouldn't underestimate what has already happened. And what has already happened is that the EU has stayed remarkably consistent and united. They've managed to manage Trump. We're talking a lot about the US national security strategy, but actually the important sentence in that strategy has been that Europe remains a very important strategic ally for the US. They can't afford to drop Europe. So they've moved last week on freezing the assets for good. Mm-hmm. That is a big issue. And there has been quite a lot of consistency. So I think that overall there has been positive progress too. We are now talking more seriously about the capital markets union again in Germany. Yeah. Again, difficult, we all know that. But I think we shouldn't underestimate the kind of progress that has been made.
We also saw in the last couple of weeks, which I thought was very striking, actually, Vladimir Putin being embraced by certain leaders across the world. Was that unexpected?
Not really. I mean, now we are in a multipolar world where everyone is trying to get the most out of it for themselves. And many countries realize that the more relationships they have with more powerful countries, that the stronger their own position is. And that is, in essence, the effect of multipolarity. So I'm not surprised by this. And if there is a ceasefire, Russia will likely be reintegrated into the global economy to a certain degree. And that is realpolitik.
Anna, thank you so much, as always, for joining us. Anna Rosenberg with some really smart thoughts on the future of Europe and, of course, what's going on between Ukraine and Russia. She is head of geopolitics at the Amundi Investment Institute. Coming up, private credit and potential bankruptcies. We discuss the outlook for financial distress and restructuring with David Morris from FTI Consulting. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Australia's Prime Minister says the country will seek to strengthen gun laws after 16 people were killed in a terror attack targeting members of the Jewish community on Bondi Beach. Ukraine and the U.S. are due to hold a second day of talks in Berlin on a plan aimed at ending Russia's war. This as President Zelenskiy is set to meet European leaders today for a major summit. And a big week for investors in the last full trading week of the year, with key central bank decisions and inflation and jobs data from the U.S. Now, we've spoken a lot recently about potential cracks in the private credit markets as debt-laden companies such as First Brands and Tricolor have declared bankruptcy. But what happens after a company declares bankruptcy as investors scramble to salvage what's left? Well, with us now is David Morris. He's head of UK Restructuring at FTI Consulting. David, thank you so much for being with us. We're seeing a lot of distress in highly cyclical industries. Chemical companies in Europe seem to be particularly vulnerable to U.S. tariffs. What are you worried about?
Yeah, well, look, we've certainly seen a pickup in restructuring activity and financial underperformance during 2025, particularly in the second half. So I am concerned that we're going to see a continuation of that trend as we go into 26. And look, you've touched on a couple of sectors there. We're seeing it across a broad range of sectors. So industrials, particularly chemicals, Western Europe, with the demand and the global supply dynamics, business services as people look to cut costs, and also consumer businesses as real disposable income has been really hit over the last few years.
But what is the concern? Is it U.S. tariffs? Is it also China cheap imports? And again, how are companies just reacting to some of these issues?
Well, look, I think the concern is, really a softness of demand whilst costs are increasing from inflation pressures. And that softness of demand, yes, there is something about supply and demand turmoil due to tariffs, but there's also geopolitical instability. The market's been volatile. In the UK more recently, people have been worried about the budget. So there's a whole combination of compounding factors. Now, what are companies doing about it? Well, look, there's been a practice of maybe trying to prolong the restructuring activity and trying to buy time. So we've seen a lot of businesses embark on liability management exercises, LMEs. We've seen people seek amendments in their debt documents, raising sort of emergency turnaround capital, and managing their businesses for cash. And they have all been designed to move the event to a better future. And that better future hasn't necessarily come. Demand is still soft, interest rates are still high.
Yeah. David, when you look at UK retail, hospitality and care and catering, it's just been a really tough business.
Yes.
Leon recently went bust despite it being full, as far as I can tell, all the time around here. Are things going to get worse before they get better?
Look, I mean, we're in the golden quarter right now for many of those businesses in terms of consumer-facing businesses, retail, hospitality. But what is certain is the consumer is really stretched at the moment in the UK. Cost of living is expensive. People are spending less. They're being more discretionary where they make that spend. So unfortunately, I do think as we come out of the seasonal period, we will see some more stress and some more failures or financial restructurings in that space.
In that space and others, or are there specific, if not company, like really specific sectors or bits of businesses that you worry about?
Well, I think any big-ticket discretionary items is obviously more vulnerable. Hospitality, non-essential spend is really where we're going to see the pain. And look, as in terms of our business, people talk about the K-shaped economy. If you apply that concept to the markets, we're dealing with the businesses at the intersection of the legs on the K and the downward leg. So we're looking at the bottom half, the lower quartile of businesses. So there will be winners, but those more challenging businesses are facing a lot of headwinds at the moment.
Any other sectors that we should worry about?
Look, I mentioned business services. So one of the things we're seeing at the moment, as businesses realise that there's probably not going to be near-term growth, they're starting to take action. They're starting to take cost out. A lot of those costs within a corporate B2B environment are business services. So we're starting to see business services, post flat or even lower revenue as demand comes off.
If you look at private credit, it's facing its first, big down cycle.
Yeah.
Again, what happens there? Because it's inevitable that things are going to go into distress or that there's going to be a restructuring situation. But how's the industry preparing for it?
Yeah, well, look, I think it's interesting. You're already seeing private credit having to get involved in restructuring activity. Now, the advantage, if you like, of private credit is a very flexible source of lending, so they can amend their banking documentation, they can capitalise their interest, they can even step in and provide new money and take over control of companies and step into the shoes of the sponsors. And we've certainly seen that happening. And we're also seeing some of the bigger credit funds either build or augment specific in-house restructuring capability, and that's either because of the volume of restructuring they're dealing with or the anticipated volume. Look, it's not a sector of the market which is going to be immune to these economic headwinds. And arguably, you could say that their borrowers are slightly more challenged because they tend to be in the high yield, higher leverage space.
And so how are private credit funds dealing with the fact that, for example, private equity holding periods are now longer?
Yeah. So look, when you look at, if you like, the private equity deals of 2018 to 2021, if you like, those stuck deals where it's more difficult for private equity to exit. Look, private credit are being supportive where they can if the credit metrics still stand up, but they're going to expect those private equity funds to continue to support their investments and provide follow-on capital. And if they're not going to provide follow-on capital, then the credit funds need to decide whether or not they step in or whether there's a valuation event.
And are they doing a good job of that, of trying to preempt and decide ahead of an event happening?
Yeah, look, I mean, they are being paid to take risk and to manage that risk. And from what I see, they manage it at the origination stage. They obviously manage it through the portfolio life. As I've talked about, they're building up their capabilities. They're pretty flexible. They can be quite patient. I think what we have seen in the last few years is one or two private credit funds step into situations probably hoping that the market would have been more buoyant and actually it would have been a shorter hold period. But now they've stepped in, they're probably looking at hold periods of 4 to 5 years. So it's not easy.
But it's not easy, but it's okay. I mean, this is like, what's the level of anxiousness out there? I guess is how I would, what I would ask you.
Well, look, it's if you look at, I would say if when I talk to my private credit fund clients, they seem pretty confident that they're managing that risk. And if you look at the larger, more established funds, they're obviously got a massive advantage because of their diversification through scale. However, they're not going to be completely immune. And I should expect that they're looking at their current portfolio. They're looking at what 2026 may bring. I suspect they're not anticipating too much growth. And so they probably are expecting that they're going to have to roll up their sleeves and really invest some time managing through that portfolio.
Do you think 2026 will be harder than 2025 overall, or will it be much of the same?
Look, personally, I think it's going to get harder. So in our business, where we advise companies in financial distress, we're already seeing an uptick in momentum towards activity, and we're seeing companies preparing to go to market, go to their creditors and look to raise capital and restructure in Q1, Q2 next year. And there's a lot of businesses we've been looking at now for a number of years, thinking how are they surviving with this huge level of indebtedness, this huge level of leverage? Why have they not restructured their balance sheets already? And that's starting to the tipping point, I think, is here. So, look, I don't want to be doom and gloom, but I do think we're going to see more restructuring activity in 26 than we have in 25.
David, thank you so much for joining us. David Morris there, head of UK restructuring at FTI Consulting. Now, China's investment slumped further and retail sales expanded at their weakest pace outside the pandemic in November. It's another month of lopsided growth that's inflaming trade tensions with the rest of the world. Well, we're now joined by Balazs Pens, our senior desk editor in Hong Kong. Balazs, thank you for joining us. So in terms of the data, what do these numbers actually tell us about the Chinese economy?
Well, they don't paint a very positive picture of the economy. As we heard, investments shrank, housing prices fell further. Even industrial output, which has been bolstered by China's very strong export performance, hasn't done as well as expected. But the big one, the main number that everybody is focusing on right now is the very, very disappointment retail sales growth, which was the weakest outside of the pandemic ever on record. And that really is what the whole Chinese economic picture boils down to. Is there a way to get the Chinese consumers to spend? This is something that we've been talking about, seems like for half a decade now. Are there any set of measures that can pierce this reluctance by the Chinese consumers to spend? And the answer for now seems like there isn't, and that is a really worrying, a very concerning sign for the economy going forward. This year, we already know growth is going to be around 5%, but there are real concerns about what this might look like next year when the domestic side, the domestic leg of the Chinese economy might be missing.
Quite strong comments, Balazs, also from President Xi about cracking down on what he calls reckless projects in the future. Yeah, that's right. And it's important to kind of look at the context
in which he said this. He was talking about this issue during the Central Economic Work Conference, which is a major gathering of economic policy planning. And his message to these kind of overlords of the Chinese economy is stop what you've been doing until now, because until now, some of these people have been rewarded by sort of manufacturing growth numbers that Beijing was looking for through some of these conspicuous spending projects, these big exhibition halls and other infrastructure projects. And what she is telling them now, stop doing that. Don't do that anymore. Focus on the long term. Focus on structural, more sustainable growth. Focus on projects that will benefit the Chinese people in the longer term. So it does suggest that there is a recognition that a pivot is necessary, and they need to focus on things that improves people's lives more than kind of contribute to very impressive headline growth numbers. So it does look like a change in philosophy for China there.
Balazs, thank you so much. Balazs Pens there in Hong Kong with the very latest on China. Now, the company that revolutionized robot vacuum cleaners in the early 2000s is its Roomba model has filed for bankruptcy. According to a press release, iRobot will be taken over by its main Chinese supplier. Now, the Massachusetts-based company enjoyed initial success with the Roomba when it debuted in 2002, but earnings at the firm, which has sold more than 40 million home robots, began to decline in the post-COVID era. Now, the former Hong Kong media mogul Jimmy Lai has been found guilty of endangering national security in a landmark trial. It's a verdict that could fuel tensions between China and the U.S. Bloomberg's Min Lo was sent this report from outside the court.
A marathon trial lasting 156 days has concluded, and the former media mogul Jimmy Lai has been convicted guilty of all charges, including 1 count of publishing seditious materials and 2 counts of colluding to conspire with foreign forces. The total verdict is over 850 pages long. The judges read a small portion of it, pointing to WhatsApp messages as evidence of his intent to collude with foreign forces to call for sanctions to be imposed on Hong Kong and China. They also found him guilty of using the now defunct newspaper Apple Daily as a platform to embark on this campaign to undermine the legitimacy or authority of Hong Kong and Beijing. Now, this is a closely watched trial. Scores of supporters queuing up overnight to enter the courthouse this morning. President Trump saying he raised the issue of Jimmy Lai's release with President Xi when the two men met at the sidelines of the APEC summit in South Korea in October, and White's group calling for his release on medical grounds as well. Jimmy Lai is 78 years old as he awaits his fate. The sentencing will be handed down on a later date, and he could face up to life in prison. Min Lo, Bloomberg News, Hong Kong.
Now to some other stories making news, and new data shows wage growth for the lowest paid workers in the UK is starting to slow. This comes as worsening jobs market undercuts the bargaining power of a section of the workforce that has proved resistant to the Bank of England's inflation fighting efforts. Now, according to figures from job search site Indeed, advertised salaries for low wage roles rose by 5.9% in the year to October, down from a 7-month high of 6.6% in the previous month. Now, staying with the UK, and according to Bloomberg analysis of official earnings and property data, average London apartment prices are now below 9 times annual earnings. That's the most affordable they've been in 12 years. A series of factors, from Brexit to tax hikes, have reined in a market once seen as overvalued, with flats in the capital now 22% cheaper in real terms than a decade ago. And France is seeking to delay this week's EU vote on a free trade agreement with South America. The proposed accord with Mercosur has been 25 years in the making, but the French Prime Minister Sébastien Lecornu says measures to protect EU farmers and consumers are insufficient. Sources say the deal could collapse if it is not signed by the end of the year. Coming up, new studies suggest the latest AI models are getting even better at persuading people at the expense of the truth. We discuss that next with Parmi Olsen from Bloomberg Opinion. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, tech valuations and bubble fears continue to dominate Wall Street. But what about AI and its impact on democracy? You know, that small thing. Supporters say artificial intelligence could help to address conspiracy theories, but there could also be a dangerous flip side. The latest AI models are getting even better at persuading people at the expense of the truth. That's the view of Parmi Olsen, tech columnist from Bloomberg Opinion and author of Supremacy, AI, ChatGPT, and the Race That Will Change the World. Parmi joins me now. So, Parmi, thank you for joining us. What are these AI models doing exactly?
Right. So there were two studies that just came out recently, and both basically showed that chatbots are incredibly persuasive. Yeah. And it's not just AI that generates a 200-word blurb about a certain political candidate. It's when people get into a conversation with an AI system that their views can actually be quite susceptible to being changed on all number of sort of policy issues. And so that was the first finding, that these things are much more persuasive than traditional TV ads or political campaign ads. And secondly, when they use the most persuasive tactics, which we can talk about what those tactics are, they're more likely to actually hallucinate and give incorrect information, mistruths.
So what are those tactics?
Well, the tactic is basically to bombard a person with as much information as possible. So in a 10-minute conversation with a person, if a chatbot gets in 25 different facts, that person is much more likely to sort of start to sway their view than if it's 10 different points that they're making in the conversation. And actually, this kind of, it might not be surprising to people, because a very popular debating tactic now, particularly on YouTube, is this rapid fire, just kind of flooding the zone with all sorts of facts, and making it quite difficult for your opponent, if you're in a debating situation, to kind of unpick and analyze what you're saying. So this is this actually has a term, gish galloping, comes from the creationist Dwayne Gish, but it essentially means just bombarding a debate with lots of facts, and that actually really works when it's AI doing it.
So in this age of social media and these rapid fire kind of debates, will AI, automatically make things worse?
It could. We don't know yet. The good news is that this is something that was shown in a study where people were paid to participate. But actually getting someone to talk to you could call it a propaganda bot, is quite difficult. Yes, many people are using ChatGPT, about 900 million a week. But it's not ChatGPT that is doing this. It would be, let's say, a campaign group. They buy access to the model, then they fine-tune it, and then they put it on a website. And somehow you have to attract people to come and talk to it, like a customer service bot. So the good news is it's actually might be quite difficult to get people to talk to these AIs. But another tactic might be to just DM them on WhatsApp or on Facebook Messenger as a bot. And then, if you're a campaign group or whatever, an activist group, that might be one way to use that persuasive tactic.
Are bad actors already using this technique?
I don't know. I haven't seen any evidence that they are. But, there's a lot of open source AI models out there, which make it, relatively cheap for anyone to do this. And this is why the scientists at Oxford University and the London School of Economics and Science and Nature journals published this report, just to kind of show how easy and cheap it is. We're talking, a few tens of thousands of dollars to actually set up an operation like this, particularly with open source models like Llama or Quen from Alibaba, which are very easy to kind of make bespoke and build this kind of ultra persuasive tool. It's out there, it's available.
But so at the moment there's no regulation, right? So you're kind of relying on the common sense of people to understand who they're interacting with.
Yes, but you can arm people with more common sense by sort of telling them these bots are out there and just to be aware of them.
Yeah, for like a specific reason.
Perhaps,
guess, right?
Yes, perhaps.
Parmi, thank you so much as always. Parmi Olsen there from Bloomberg Opinion, our go-to person for anything ethics and democracy and AI. Now, it's a big week of risk events for investors. investors, central bank decisions due from the Bank of England, European Central Bank, and Bank of Japan. We also get a lot of U.S. data, October's partial CPI report and November's full one, 2 non-farm payroll releases, and November's unemployment rate. Now, for more, let's bring in Ven Ram, cross-asset strategist for Bloomberg MLive. Ven, so good to speak to you. So which of the central banks do you think will be most interesting this week?
Morning, Francine. A pleasure to be talking to you. I think that, at least 4 central banks in Europe meeting, and not to mention the Bank of Japan in Asia. But I think the one that's going to be the most interesting is going to be the Bank of England, because the markets are pricing in at least 25 basis points of rate cuts from the Bank of England, even though this is a no press conference meeting. So I think that, how reactive is the Bank of England going to be to the budget is the key question here. And are they going to pivot dovish? 1 month ago, the markets were not even pricing in a rate cut in December. Now they've brought forward the rate cut to December. So that shows how the market views the BOE's reaction function is going to be. And I think if the Bank of England shows that it is capable of going much further, I think that the pound will sell off, and I think that the BOE's reaction function is going to be in focus. As far as the ECB is concerned, it will be the updated macroeconomic forecast that will be in focus, even though nobody expects them to cut rates anytime soon.
On the Bank of England, how are you thinking about the pound, Ven?
I think the pound has bounced off, has made a tentative rebound in the aftermath of the budget, because the risk premium that had been embedded into markets, UK assets, has unwound partially. But those gains are at stake if the Bank of England is going to say, look what, the markets are pricing in a terminal rate of 3.5%, which the Bank of England Governor Andrew Bailey has alluded to as being the right ballpark. But if he suggests that the Bank of England is willing to go further than that, then I think that the markets and the pound will sell off, because that's far more dovish than the markets have priced in.
How's the Treasury market likely to react to the jobs data and CPI reports, Ven?
Well, I think that, the markets are very interestingly set up ahead of the November non-farm payrolls. I think, if we get an expansion, the question will be, when is the next rate cut from the Fed due? And if you look at the 2-year yield, it's done a very interesting plot on the charts. It's refused to go down below 350 meaningfully for any period of time, even though we are almost flush with the Fed funds rate at the current level. So the markets are kind of, turning somewhat skeptical at all these Fed rate cuts, saying, your core PCEs are hovering around 3%. The economy is doing well. In fact, we just heard from the Fed that they expect the economy to grow 2.3% next year, which was a huge revision upward. So I think that the markets are beginning to question that, look, do you need further rate cuts from here? And that's the reaction that I'll be looking out for from the front end.
Ven, overall, what do you think will be the main driver for 2026? I know there's going to be a lot of concerns about valuation, NAI, Fed. It feels like it's going to be the similar themes, unless there's something else we should watch out for.
Well, I think AI, the bubble in the making, is a big deal to watch out for. Fiscal expansion in Germany and Europe is a big theme as well. And I think that, increasingly the markets are going to be looking at the credit metrics as well, which is little watched. And I think one more area where I would be looking at with great interest is what the SNB does with its policy rate. I know last week that they said that they're not inclined to take rates below 0. But I think that, but they also lowered the inflation forecast. But if they continue to see inflation going down to deflationary territory, I think that, they will pull the string on the one more rate cut. And even though they're reluctant to do it, that's a tail risk that the markets are not thinking about just yet.
Ven, thank you so much. Ven Ram there from Bloomberg MLive. Now, this is a picture across the board for markets. Again, as Ven was saying, it's just a big week, the last full week of 5 trading days before the end of the year, and U.S. futures pointing to a slightly higher start. You can see S&P futures gaining 0.4%. Up next, it's Bloomberg Brief, and this is Bloomberg.